Hey there, and welcome to This Explainer. Today, we're unpacking a truly fascinating macroeconomic mystery. It's a story of global finance, shifting policies, and a completely hidden force that directly impacts the crypto market in ways most people just gloss right over. If you want to understand the true undercurrents driving asset prices right now, you are absolutely in the perfect place.
So what is Bitcoin's biggest threat? If I asked you to guess, your mind probably jumps immediately to the usual suspects, right? You're likely thinking about the Federal Reserve raising interest rates, or maybe fluctuations in spot ETF inflows, or perhaps sudden regulatory crackdowns. And hey, it makes total sense. Those are the headlines we see plastered everywhere every single day. But I want you to completely reconsider that assumption. We need to look away from Washington and Wall Street for just a minute.
Because the real answer, the totally unexpected culprit here, is actually Japan. Yep, Japan. For decades, they've quietly been the world's primary source of ultra-cheap money. They've essentially pumped the entire global system with liquidity. But now, something genuinely historic is happening over in Tokyo, and it threatens to pull the rug right out from under global risk assets.
Chapter 1. Crypto's Unexpected Macro Threat. Okay, to really grasp the impact here, we first have to understand the mechanism behind it. It all comes down to a practice known as the yen carry trade. Basically, it's the strategy of borrowing yen at near-zero interest rates to invest in higher-yielding global assets. You see, for decades, Japan maintained extremely low interest rates. This allowed investors to borrow literally billions of yen almost for free, turning Tokyo into one of the largest global liquidity engines in all of financial history. Okay, let's dive into this. The mechanics are actually surprisingly straightforward. Step 1. You borrow cheap yen because the interest rate is practically zero. Next up, Step 2. You take those yen and convert them into US dollars. And finally, Step 3. You use those dollars to buy assets that offer a much higher expected return. You're essentially just pocketing the difference between the 0% you pay to borrow and the high yield you earn on the asset. Easy money, right?
So what exactly were investors buying with all this free money? Well, pretty much everything. U.S. Treasuries, high-growth tech stocks, emerging market assets, and eventually Bitcoin and crypto. When money is this cheap, investors are highly incentivized to chase risk. Abundant liquidity just floods the global system. And because crypto thrives on abundant liquidity, it is absolutely no coincidence that some of Bitcoin's strongest historical bull markets have lined up perfectly with these periods of extremely loose global monetary conditions funded by Japan.
But the rules of the game are suddenly changing. Chapter 2. The End of Free Money. 2.7%. The Japanese 10-year government bond yield recently climbed above this mark. Now that might sound like a small number, but it is a staggering figure when you consider the context. This is the highest level we've seen since the late 1990s. For a market that is so accustomed to yields at zero, or even below zero, a 2.7% yield represents a fundamental earthquake in borrowing costs. Let's move to and see how this builds, because the historic shift playing out over the last decade is wild. Back in 2016, we saw ultra-low, even negative yields. By 2020, rates were basically flat, but in 2024, the Bank of Japan officially began policy normalization. They started exiting negative interest rates driven by inflation that just remained stubbornly above their long-term target. And as we project forward toward 2026, markets are bracing for multi-decade highs. The era of essentially free Japanese money is rapidly closing. For years, global portfolios functioned on one massive core assumption: that Japan would just remain the world's cheapest funding source forever. Entire investment strategies, literally trillions of dollars in leverage, were structured around this single premise. The gravity of the Bank of Japan suddenly exiting this aggressive monetary experiment cannot be overstated. It shakes the very foundation of global liquidity. Which leads us right to Chapter 3, the domino effect. We actually have a real-world example of this from August 2024. When expectations for Bank of Japan tightening intensified, Bitcoin and broader risk assets experienced significant volatility. And this happened because as yield spikes are driven by policy tightening, investors immediately reassess their leverage. They realize their borrowing costs are suddenly going up, and they scramble to adjust, causing risk assets to stumble.
Now, to be fair, we have to acknowledge that the statistical relationship isn't completely perfect. Bitcoin is influenced by a highly complex web of variables. We've got ETF flows, the Federal Reserve's policy, stablecoin issuance, general global risk appetite, and, of course, regulatory developments. All of these factors push and pull on the price on any given day.
So, the crucial point is this: liquidity is the common denominator. Expanding liquidity has generally benefited crypto over its entire history. It gives it the fuel to run. But periods of liquidity contraction, those create severe headwinds. And the yen carry trade sits directly at the center of that global liquidity equation. So, when the carry trade shrinks, liquidity contracts.
Chapter 4. The Bearish Dominoes Fall. Let's look at the mechanical breakdown of this unwind. First, as Japanese yields rise, the yen strengthens. This directly causes global borrowing costs to increase. Suddenly facing these higher costs, large institutional investors begin unwinding their leveraged positions that were funded through that cheap yen. Ultimately, that capital flows right back into Japan. This actively removes a massive support structure for equities and crypto, aggressively shrinking the total pool of global liquidity.
In this specific environment, Bitcoin faces very clear mechanical headwinds. We'd likely see lower speculative demand across the board. There would be drastically reduced leverage in the system. Consequently, we'd experience increased volatility, which, as we know, often triggers larger cascading liquidations. The point here isn't that higher yields automatically crash Bitcoin. It's that they remove a quiet, vital source of support that has been propping up risk assets for years.
But let's flip the coin. Chapter 5. The Bullish Counterargument.
The primary counterargument here is that Bitcoin has fundamentally evolved since 2018. I mean, think about it. We now have significantly larger institutional adoption. We have the massive new demand channel created by spot ETFs. We're seeing corporate treasury expansion with major companies holding Bitcoin right on their balance sheets. Today, Bitcoin increasingly trades as a mature, global macro asset rather than just some niche speculative instrument. So, these massive new demand channels might just be strong enough to offset the structural pressure coming out of Japan.
And this brilliantly illustrates the massive liquidity tug-of-war we are currently in. On the bearish side, you've got shrinking yen liquidity and the unwinding of global leverage pulling one way. But pulling back hard on the bullish side, you have relentless ETF inflows, growing sovereign interest, and deep institutional adoption. It is a true battle of structural forces. Higher Japanese yields will absolutely create volatility, but on their own, they may not be powerful enough to end the broader cycle.
Ultimately, the outcome of this tug-of-war depends on the delicate balance between two financial titans, the Federal Reserve versus the Bank of Japan. For years, crypto investors focused almost exclusively on the Fed. But to understand this next phase of the market, you really have to watch Tokyo just as closely as you watch Washington. Global growth and investor demand hang in the balance between these two central banks.
Which brings us to our ultimate takeaway for this explainer. In crypto, liquidity has always been king. If Japan truly exits its ultra-low rate era permanently, the impact extends way, way beyond the Japanese bond market. It reshapes the very nature of global liquidity, and any shift in liquidity is the single most important signal for crypto investors to watch.
So, I leave you with this final provocative thought to ponder. Are these rising Japanese yields just a temporary scare causing a brief bump in the road, or are we witnessing the beginning of a major, permanent shift for Bitcoin and global markets? Honestly, it is the most important question in macroeconomics right now. Thank you so much for joining me for this explainer. Keep your eyes on the data and never stop learning.